Welcome to Nasdaq Trade Talks, where we meet with the top thought leaders and strategists in emerging technologies, digital assets, the regulatory landscape, and capital markets. I'm your host, Jill Malandrino, and joining me on the desk at the Nasdaq Market site, we have Chris Dearborn, Managing Director on the Nasdaq Market Intelligence Desk, Kevin Flanagan, Head of Fixed Income Strategy at WisdomTree, and Padhraic Garvey, Head of Global Debt and Rate Strategy at ING. We're here to discuss the implication of tariffs on prices and inflation in the U.S., what the Fed is likely to do, and how fixed income is responding to all of this. It is great to have a couple of bond guys on the desk with us. We certainly know what's happening in the equity markets, but it really has been the story and how the bond market is digesting this for sure. Kevin, what are your thoughts on a high level overall where we are with the macro right now?
Well, I think what was important would be finding out the economy was in a pretty good place before Liberation Day, right? For lack of a better way of saying it. I know, well, that's yesterday's news. We need to focus on where we're going. I get that, I understand it, makes perfect sense, but I look at it, wouldn't you have rather had an economic setting that was on a pretty solid backdrop heading into this uncertainty, instead of one that was faltering or begin to weaken? So that's kind of how I'm focusing.
Yeah, which makes sense. You kind of rip the Band-Aid off instead of wondering, when are we going to start to have this tariff conversation? Right, this way, it's starting in the beginning of 2.0 versus trying to figure out, are we going to have this conversation 2 years down the line? Focusing on treasuries specifically, because that has been a big part of the conversation since we have a lot of foreign investments within that market. How are they settling, if they are, back into their role?
They're back into the role, but I describe the treasury market as a Jekyll and Hyde market, in the sense that if you go back to Liberation Day, we had the classic reaction. Treasury yields collapse lower. Lasted for 2 or 3 days. So that was your Jekyll. Then we had the Hyde version, where treasuries sold off. They went from 385 to 460. That was a very dangerous period. That was a period where if you were a foreign investor, you were losing 10% on your treasuries and your currency movement. So yes, it's settled back down again. It's more calm now. We're back down at 430. It feels like it's a normal treasury market again. And I mean, I feel from here that we should be pricing a recessionary environment and treasury yields can move to the downside. But I really fear we're going to see another bout of treasury selling at some point over the next couple of months.
Yeah, because you typically don't see moves like that over the 2-3 days that you had just referenced in the treasury space. I mean, it doesn't lend to a lot of confidence.
No, I've been in this market far longer than I prefer to admit to. I have never seen a market like that, where nothing new happened. April 2nd, April 5th, all we had the tariffs. April 5th to April 9th, nothing happened, but Treasury sold off. Remarkable stuff. Yeah. Very worrying. And this is why on April the 9th, the administration decided to change their tack. I think the most troubling aspect for me was the widening in the Treasury swap spread. I mean, that got out to 65 basis points. If you look at that particular day, it was huge volatility. And I have to say, I was looking at this and I was thinking, man, this could be 75 tomorrow. This could be 100 in a week's time if it stays here. But thankfully, we have settled down.
Yeah, which is interesting, Chris, coming from the equity perspective, you and I, through .com, 9/11, GFC, COVID, and so forth, I can't recall another time where the volatility, not just the numbers or where the VIX is, but the composure of the market felt quite as chaotic as this particular bout.
The risk-off factor got thrown out the window. Usually equities and bonds are moving in opposite, and you take away the zero interest rates that we had and kind of fluctuated a little bit differently than what traditionally they worked at. But it seemed almost prior to the 9th of April that it was a sell U.S. movement, right? And you've read plenty about it, that you had some of the foreign issuers that were just selling U.S. treasuries and moving to other assets outside, because now it's not Tina here with the U.S. markets. There is no alternative. Now you've got potential for alternatives into Europe and other regions where they may be able to get some better yield with a little bit more stability, because at the end of the day, we're really still uncertain of what's going to happen. Did the 90-day reprieve really get us a reprieve? Only if he gets some of the deals that he wants done or accept something so he can walk away saving face and the other countries can walk away saving face. But until we get that normality, the markets are in flux, the equity markets are in flux, companies are pulling guidance across the board because you can't model out. And that should be very interesting for the bonds, but it isn't as exciting as it should have been, and a little bit too much uncertainty. You know, when you look at the MVOL and some of the other ones, it's very nerve-wracking if you're an investor, and that's, I think, one of the reasons why you see the flight to gold and other alternative currencies, because they're unsure. You want to preserve principal, you fly to the bonds in an uncertain market, but that wasn't secure either for a very significant period.
In fairness, though, we did see Europe outperform the U.S. for the valuation story, and gold was having its run, you know, even prior to 2025.
Still kind of is.
You bring up a great point, Kevin, that the market needs to stop speculating on what the Fed would do versus what it could do or what it's likely to do. There's an important distinction there.
Well, yeah, I mean, you hear it all the time, right? I guess I could be guilty of talking head. This is what the Fed should do, but we should be focusing more on what we think they're going to do. And I think Powell and company have given us some pretty good guidance on that front. They're highly data dependent. I don't see that changing at this stage of the game. You know, looking at the data, let that come to them and they will make their decisions accordingly. I think the other thing, interesting point that I wanted to make following this kind of bout of Treasury volatility is for investors in bonds who are looking for AAA sovereign alternatives. There aren't many out there. And I think you also, you know, you get a sense like going forward, I think treasuries is still going to be the area that foreign investors are going to focus on. There's only so many bunds out there and other AAA sovereign alternatives. If you go and actually look at some of the charts, you see in mid-2023, there was a decent amount of AAA sovereign debt. That's because Fitch hadn't downgraded the US yet. In, I think it was July of 2023, Fitch downgrades us, so now 2 out of 3 are AA+, and it just dropped like a stone. So what is the alternative is what I would ask. You mentioned Tina, what is the alternative if you are moving your money outside of treasuries?
Yeah, I mean, you also have to think about liquidity as well. When you hear about the dollar, everyone's moving away from the dollar, they're moving away from treasuries. It doesn't quite work that way from a mechanical perspective. You know, you need the liquidity to do so.
Absolutely, and the dollars don't disappear. They've got to go somewhere.
Yeah.
So it's a manifestation of the current account deficits we've run here over a number of decades. Dollars are abroad, they get invested back into the US. I fully agree. There is no alternative to the treasury market and the dollar. But I think what happened 2 weeks ago, we can't unsee what we saw.
Right.
I mean, it was pretty painful. If you were sitting there as a foreigner and you blindly go into treasuries because it's risk off across the board, and you're getting crucified by 10%, you're going to think twice again. So what you're probably going to do is, yes, you may ultimately be forced into treasuries, but you're going to dip into bonds, you're going to dip into other markets that offer you some alternative, if you can. I mean, clearly if it's a dollar investment, it's more difficult. But I mean, that's what makes me nervous. I agree. I don't think the treasury market is doomed, but I'd be astonished if that was the only example of selling that we're going to see in 2025.
What I would say, you know, there's also within the treasury market, you don't have to put your money in a 10-year, a 5-year, or a 30-year. There's treasury floating rate notes. And if you look at them, they're 2-year maturities, but they're reset every week with the 3-month T-bill auction. They were as straight line, no volatility whatsoever. So there are other options in the treasury market. You don't need to be putting your money in a 10-year note in periods that we just saw of stress or dislocation. There's other parts of the treasury market you could be focusing on.
Why do you think it didn't see volatility within that tranche?
Well, you know, I mean, you're talking about essentially 1 week duration. You're not moving out on the curve. It's something that's reset every week. So there really is that, it's almost like buying a T-bill, but it's T-bills plus a spread. So I think given that environment, you're very much akin to it being in the T-bill, very ultra short part of the curve, which if you are looking to make a decision like you said before, or moving your money somewhere else, or maybe into bunds, that's probably where you'd rather be than having to worry about what's the 10-year price gonna be now versus 24, 36 hours from now.
Yeah.
That's where you should be. That is the safety trade. You minimize price risk. But this is the issue. The next time this trade is put on, that's what guys will do.
It's going to get you crowded.
They could be selling 10s
Yeah.
because they're concerned with, okay, I mean, if him and him are going to be selling, I don't want to be selling to them. I want to be on the same side as them. That's the issue. And I think the other narrative with regards to this Sell America story is that there's a lot of talk about Chinese selling. May have been true, may have not have been true. I do notice in auctions that there is a bit of a lower official bid. Foreign bid seems to be the same, but the official bid is a bit lower. But you don't have to have foreigners selling treasuries to hurt treasuries. Domestics can sell treasuries too. I mean, fund managers aren't going to hold on to treasuries from a patriotic point of view. If there's enough selling, it's vulnerable. So I think we are exposed to that risk at some point over the next couple of quarters, because there's no solution to the fiscal deficit as of yet. We're going to have inflation above 4%. There is a very difficult and uncertain policy prescription ahead. I was surprised when Scott Bessent announced July the 4th as being a target date for big tax cuts. I was surprised Treasury markets didn't react to that. The only rationale for not reacting to that is that, well, it's Congress decides, not him, right? So, but the day that Congress passes a big tax cutting bill along those lines is a day when the Treasury market is going to say to itself, well, really? Are we going to do that?
Yeah.
Well, it goes back to right after Election Day. What was the knee-jerk reaction to Trump and the Republicans winning? Treasury sold off. And it wasn't really, I mean, we got to 480 on the 10-year in January. And then when the conversation turned to tariffs, that's when things sort of changed a little bit. And back to what, foreign selling, unfortunately, the official data we get, the TICS data from Treasury, is with a lag. But through the first 2 months of the year, China was actually buying.
Yeah. Chris, from an issuer perspective, because you spend all day, as your team does, on the desk talking to Nasdaq listed companies, how are management teams perceiving this environment?
Right. So on the consumer side, they're very, very cautious, right? You have supply chain risk. You've got consumer risk, especially with inflation, continue to be very sticky. There is concern about employment, even though the data, the non-farm payrolls was very strong. The unemployment data still just seems very sticky. If you look at, there's a big difference between the hard data and a lot of the other surveys. So if you're looking at consumer confidence, the CEO survey, there's a lot of angst in those surveys as well. So you're seeing it starting to impact earnings calls. Companies, like we talked before, we starting to pull guidance. That's never really a good thing, but it's not really a bad thing either, because you're uncertain. You don't want to give guidance in an uncertain environment. So it's okay to pull a quarter or two or three till it starts to settle out. But the angst is there. They're uncertain about policy. They're reaching out to people across multiple legs to try to get as much information as they can about what they think they might best, how they might best navigate this situation, even though they have no control over it. But the supply chain issue is the biggest item right now, especially on the input level, and that's not going to change much, even over the course of the 90 days. It may work itself out fine, and expectations are that everything will be better, maybe a little bit lower, but better over the next 6 to 12 months. But I want to turn to the Fed, because we didn't talk about the meetings this week. The futures are not pricing in any cuts whatsoever, and barely, it's a 30-60 split for what might happen at the next meeting as well, because the hard data is really not showing that we're having any issues here. The economy is still chugging along fairly well. So again, it's potentially politicking, but it's definitely headline grab. Whatever the reason may be, the angst is there, and that's what's causing investors to run a little bit for the hills. The quality companies are doing much better, but the majority of the companies that are, cash burn or not doing well or don't have that have exposure to tariffs are still suffering tremendously.
Right. I think if you think about it from a longer term perspective, and I believe this is what you were alluding to, even if we were to get, let's call it a resolution in July, the operating environment, the policy environment, that's a longer term concern. How does that reshape what global trade looks like? How does it reshape how you were able to operate as a company within the AI cyberspaces? Now that it's a national security conversation, policy takes time to develop, and it needs Congress to act to legislate. So I think that is sort of what you were alluding to, longer term, that just one tariff sign off doesn't necessarily change the landscape. Yeah,
I mean, there's a couple of things. First of all, we still have a 7% deficit. And we don't really have a plan for that deficit as of yet. So, I mean, it's an issue that the Treasury market is just parked for now. Once we get confirmation of big tax cuts, if we get confirmation, the Treasury market then has got to factor that into its decision making and decide, well, okay, this is going to mean this extra supply. How do we react to that? I could see treasuries taking that poorly. Now, the counter to this, and going back to your point, is that we don't know what the future brings. We saw Friday's payrolls report, and the activity data is fine, employment is fine. But if you want to have a forward-looking indicator for corporate America, it should be coming from equity markets. And equity markets have told us everything's okay. Whether that's true or not, I don't know. But we have closed that gap right back to April the 2nd.
Yep.
So that's what we're dealing with. We're dealing with an expectation vehicle that you can pick holes in because the equity market hasn't got a great record of predicting the future. But it's doing what it's doing, which is hugely positive. So I see a big negative for treasuries potentially from the lack of a policy objective to get the deficit down. But I'm really heartened by what I see in terms of the equity market discount.
Yeah, well, I mean, Chris, the way companies operated, let's call it over the past five and a half years, 2 elections,
Right.
COVID, a number of uncertainties, and some of them operated quite well.
They did. I mean, zero rate interest definitely helped
Of course.
a lot of companies, right? So you could borrow, beg, and steal to move along your business, and it didn't really cost you anything. And now it's starting to cost a lot of the companies, like we said before, the smaller companies that are cash flow negative, which is nearly almost half of the Russell 2000, are suffering right now. But the larger companies are doing very well. The equity markets are definitely forward thinking. They're usually 12 months plus out. You just look at the PE multiples that you get from most companies, especially on the tech side. But a lot of the companies are also not doing as well because they're pulling back. You're hearing companies are pulling back in a lot of different sectors. You read yesterday alone in the energy sector, a number of the companies are pulling back on the drilling and number of rig crews that they're bringing to market, not because of lack of black gold in the ground, but because they're uncertain of where they're going to be and how they're going to output it. So that's just another factor away from the consumer. The markets are forecasting that we will be okay if we get clarity. I think the same is for the bond market as well. I don't think clarity's there. The deficit is a huge issue that they're trying to deal with, and I don't think, as you said, Patrick, there's no plan. It doesn't seem like there's a plan.
Because that's not Fed.
Right.
That's fiscal, and there's
Right.
a big difference there.
Yep.
So it's not as if somebody has the oversight, such as Powell, who can make those, and his team to make those decisions. Fiscal policy is a different
Powell's
animal.
still the rock right now that's holding us together, and everyone believes in Besson, as the saying goes right now. So if you can have the calmer heads kind of prevail here, maybe there'll be some clarity. But you never know. You're one social media post away from Lord knows what. So it's interesting times, to say the least. But if the unemployment numbers stay relatively low, if the hard data continues to be accountable and measurable and consistent, the equity markets will continue to reward the companies that are the good players and do well.
Right.
Right. And I think that's where we are right now.
And Kevin, that's why you don't see the Fed pulling levers, because there's really no reason to if the economy maintains its stance.
Right. Not at this point. I don't think they want to, have the situation come back and bite them that they moved too soon. And I think when you look at, say, the future, if you look at jobless claims, one of the 10 leading economic indicators, I know it ticked up a little bit last week, but if you go back to like 1980 and look at prior recessions, we're still about 100,000 below where we were to these prior recessions. So there are some, I think, positive signs out there that we can perhaps weather the storm. And we were talking about clarity. One of the things we do have clarity, regardless of what the Tax Cut and Jobs Act of 2025 is going to look like, we do know we're running baseline $2 trillion deficits, and that's not going down anytime soon. And to the point that you were making before, odds favor that's probably going to go up. So, it's funny, we're all consumed talking about tariffs now. I would argue third and fourth quarter of next year, kind of the point that you were making, is that it's going to be a different conversation. We're going to be talking about deficits, increased supply, and what does that do for growth? Does that help to offset perhaps some of the other uncertainty out there?
Yeah, well, I guess flood the zone, right? Isn't that what they say, just to keep things interesting? I appreciate everyone's insight. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.